Hello guys, good morning. Today is Saturday, September 3rd. I'm gonna be doing a little bit of a resume on this week's price action, avoiding Friday because it was NFP, and when it's a Friday with NFP, it's better to just avoid price action completely. So yesterday, as an example, I was analyzing price and everything, just not in any way to take a trade, not even on demo, right? So just NFP is better to just avoid completely. And we're going to be talking about a couple different things today. We're going to be going over the usual stuff, right? The stuff that the way that I apply ICT's concepts, what traits showed up with that, with I don't want to say my strategy or just the way that I execute traits based on ICT's concepts. And in the meantime, we're also going to analyze a little bit of, well, not a little bit, we're going to analyze price action of this week with a little bit of ICT's new content, which is the core content, which is from his mentorship, paid mentorship of 2016, I believe. I don't know if he'll upload the entire mentorship of that year. That will be great. I've seen just month one, little bit of month two, kind of at the end of month two, I believe. Not entirely sure. There are a couple of things. Fibonacci uses Fibonacci a lot on that. Talks a little bit about fair value gaps as well. Order blocks, which order blocks, kind of understanding a bit more what he actually looks for, like what is an actual order block for him. And I've been able to spot them in the on price basically a little bit better. But again, nothing very special so far. And of course, I'm still going to be trading the way that I've already explained a couple of times as an example in the video, where I explain exactly that, right? So yeah, we'll begin with Monday. And Monday, if we go back to the basics, I wait for first a run and stops, second displacement in the 5-minute or 15-minute, whatever comes first. And with that displacement, we need to see a market shift, right? And something that I don't know if I misunderstood at the time, or if I just understood it in a certain way. As an example, we could say that this tiny bit of a low created here could be considered as a market shift, as that is broken, right? Is you have like a tiny bit of a low that is created, price breaks through that, and well, we then have this fair value gap. So we have a market shift and then the fair value gap, or well, we had this fair value gap from earlier, right? Thing is that the market shift, when the structure is broken, that's when the displacement has to be created, or something like that, right? Or something like that. So I'm saying this. So when you watch ICT's concepts, or not concepts, videos, you check it out for yourselves, right? Because I've kind of understood that the market shift has to be a high or a low being broken with aggression and the displacement happening. Otherwise, there's no market shift, right? So that's something that I might have misunderstood when studying, and well, yeah, it's something very important, of course, because it could allow us to miss out on a couple of bad losses. Okay, we're going to begin with Monday, and Monday was a day where I didn't take any trades because 8:30 begins here, and you can clearly see how price has been quite aggressively bullish. We have the power of three concept and a market protraction concept that I'll explain in a minute. But basically, midnight opens actually here, not there, here. Trades a bit higher, then goes aggressively lower. We have run on sell side liquidity. And then you can see how it changes direction. And this is an example. We could have even applied the other way around. We could have applied Fibonacci, and as you can see, we have a couple of levels that are mitigated and could have been used as that. Maybe on the 15-minute, we had somewhat of an order block, which we kind of do, which in my opinion will be these two candles. And as you can see, price does mitigate them and goes higher. So market protraction and impulse swings is, if I remember correctly, around the end of month one of core concepts. And an impulse, or well, yeah, an impulse swing will be basically just this. This is an impulse higher or swing higher, impulse lower, impulse higher, impulse lower, impulse higher, right? So it's just movements of price, basically, without giving it much thought. Every single move is an impulse swing, right? Or something like that. I'm going to paraphrase a lot because, again, I've watched this specific content. I've watched that only once, and I'm barely understanding it, right? I'm learning, starting to learn, basically. So a market retraction is exactly that. It's a price swing, but that happens at a specific moment. As an example, this will be a market retraction that happens at 0 hours, right? At New York midnight. So around New York midnight, we tend to see a move against what could be the trend for the couple of hours ahead, or the time ahead of that opening, or whatever it is, right? So as an example, here we have a move that goes against the trend and then just continues going aggressively higher. Here around New York, he said on the video, he said New York open, but this is like the kill zone open. But he said 7 a.m, so that's what I stuck with. You can see how price, this will be a market retraction because it's an impulse swing that is happening. It's time sensitive, right? Time sensitive. So basically price goes against the trend and then continues higher. And then we have a 30 open. As you can see, price does go lower, but then goes aggressively higher twice, actually. Going above a 30 open, so above that price. So this could be considered market retraction on both times. But I'm not entirely sure what would happen if price actually like comes back twice above that price in this case. Also, we basically have like the power of 3. I don't know if from this concept then the power of 3 is created. I have no idea, honestly. But basically, as you can see here, we do have price trading above this level and then going in the contrary direction, right? So price opens, consolidates a bit, goes against the trend, goes lower. This could have been a FIBO. Decided to apply it. In my opinion, no, doesn't look that well, honestly. And well, just continues lower, right? Of course, this is the, well, actually the end of the kill zone is here, right? That's actually 11 a.m. So this is something that we might have not even gotten the chance to trade. So going back to what I already explained, we have run on sell side liquidity through midnight. We have power of 3 working out with the midnight open. Starts going aggressively higher. London retraced down to an order block that we already discussed, even levels of Fibonacci, and then we see price just going extensively higher. What could we expect the price to take on this day? Maybe this high, although as I mentioned for the week, I was expecting a bearish week, or maybe a bullish week to get above this high, which is previous week's high. And price didn't get there. It basically ranged between this high and the this low, I think. Well, this low for sure. I don't really remember which one it was that was actually respected. So basically we have a bullish trend when we begin near kill zone. Near kill zone also has this power of 3, or basically price going against the trend, or as I've explained previously, that phase 1 tends to go against the trend. Phase 1 from 7 to 830, that's what I consider it, tends to go against the trend and then create fair value gaps for phase 2 to trade into and then potentially buy, right? So as an example, we could have been expecting for buys here. Now, the problem that I had today, well, not today, this day specifically, is that we never got the run and stops to then look for fair value gap or, well, displacement along the market shift to try and buy or sell, right? Because we could have said this is liquidity, price trades above it, displaces, causing a market shift when breaking this low, right? And then you have the market shift, sorry, the fair value gap right here where we could have looked for sells. But this was so compressed price action and going very against the trend, right? Because it's literally pretty much against the trend at that point. And as you can see, this low was not broken or anything close to that. So the trend was basically being respected over and over, bullish wise. And for me to buy, I would have needed, as an example, either this low being taken and then the displacement, or this low being taken, which with the 830 open would have been nice to see this being broken, displacement, lower time frame entries inside 5-minute or 15-minute fair value gap, and go with that, right? We never really got confluences to buy. We never really got confluences to sell, unless, again, we would have gone for this little bit of an aggressive run on liquidity, like tiny run of liquidity, and then supposedly a market shift in the 5-minute. For me, that was not enough. So basically, Monday was no trades for me. London would have been nice, although based on what I trade personally, I would have not found any kind of entries, right? Unless we would have used this, right? The Fibonacci, but that's new stuff. I don't want to get into that. I don't want to change the way that I trade currently. So yeah, that is pretty much it about Monday, honestly. There was not much to go through on Monday because most of the move basically happened around London. You can see here how price went aggressively higher, and New York opens on this candle, which goes lower and then starts going higher. And that is really pretty much it about this day. There was nothing for me to do. So a couple of things about Tuesday. Tuesday had midnight open here, trades a bit higher, ranges, goes lower, taking sell side from these points, right? Mitigating previous day low, right? Oh, we also have this tiny run on sell side right there. So you can see, starts going higher, midnight, trades a bit higher, ranges aggressively lower, aggressively higher. On London, after again taking this, potentially mitigating something in here, right? That's maybe what caused this entire thing to work out, right? And then just goes aggressively higher, right? If we look at what happens through pre-New York, it basically ranges. We do have somewhat of a market shift when breaking this low with the displacement. This is an area where we could have looked for sells if it happened at a good time, but as you know, it didn't happen at a good time. Goes a bit higher, then aggressively, you can see how we have displacement, we have a clear market shift and everything, and phase 1 starts on this, and this is also the market protraction thing, right? So it opens at 7, trades a bit higher, and then immediately starts trading lower, right? So it's really nothing new from what we've already discussed about the manipulation and the power of 3, right? Opens, trades a bit higher, making or inducing or manipulating people into believing the price through the session could be bullish, right? Or to continue what we've had through London. And then all that it really does is turn around quite quickly without really giving it much of a chance. Afterwards, how could we determine the trend on this one? This one would have been complicated because, as an example, we do have this aggressive move lower to then go higher, going below the midnight open. So that could have been sell side being taken, price at a pretty good discount, could potentially go higher, right? That could have been a lot of confluences to go against. And the only reason why we could have sold and why I actually took a paper trading on this, but this is not a trade I would have taken on something like a challenge or a funded account, is because we can see price creating some liquidity from here. I do believe we had something to 11. Yeah, we had this previous day's low basically, and we had the sell side being respected multiple times. We have first reaction was yesterday's, then this low created through Asia, or Asia, then another low around the same level, aggressively higher, takes buy side from all of these levels, so you can see all of those levels. And also now that we think about it, this is a flag, right? A bullish flag. I think it was called the price pattern. So price breaking above here, there are a lot of retail traders with stop losses below the low and looking maybe going above this high or maybe targeting this high. I'm not entirely sure. I don't remember how this pattern worked out, but basically a lot of sell side liquidity pending here that price could have looked for. So based on what we have, session starts here. It doesn't really matter at this point. But basically we have that through the night, we had aggressive price action going above previous day's high, a lot of buy side liquidity and a lot of sell side liquidity pending below us, right? So it was definitely understandable why we could have looked for sells. And through pre-New York and a little bit of New York, we get multiple confluences to believe that, right? We have pre-New York, well, actually London creates a bit of liquidity. Pre-New York takes that liquidity and immediately shows signs of price wanting to go lower. Then this high is taken as liquidity. You can see the clear market shift along with the displacement. Price trades inside that displacement. We have this little bit of manipulation, price going a little bit higher to then go completely lower, basically just following the lower lows, lower highs, right? Price just continues with that trend. Session opens here, goes aggressively lower, aggressively higher because of this, as an example, because right, we're going to have situations where, sure, it opened here, and it went lower. Could we consider this as a manipulation to now go higher? Definitely, right? Definitely. And if I remember correctly, I did take a loss on this buy here because price traced into this, being this to break the market shift, right? This the fair value gap in the 5 minute, and then price trace into that in the 1 minute. We do get an entry, which I do remember taking. The question is if I would have taken this one funded challenge, and I don't remember because I did say it through my Telegram probably. So I can't really remember. Based on what we have, based on the session, sorry, not the session, the what happened through the night, we could expect a bullish day, but the thing is that we have a lot of sell side pending, right? We have a lot of sell side pending, and we've taken a lot of buy side. So it would have been difficult for me to buy here, but we do have some really good confluences to do so. So I can't really say for sure, but the thing is that we have to understand that both the buy side and the sell side have good confluences, right? Because we have this price action basically being respected to the downside. And basically, if we get into a little bit more detail, what happens? A30 opens, goes a bit lower, goes aggressively higher. We have a high being taken. This could be the market protraction or basically just price manipulating. And what is it that we will look for after a run and stops? Run and stops, displacement with market shift, lower time frame entries inside 5 minute or 15 minute fair value gap. Do we get that? We don't, right? Because we definitely have the run and stops, and we can clearly see it's a run and stops because it goes aggressively higher and immediately turns around. It just took liquidity to change directions. Market shift on this, but if we check in here, this will be our area to look for fair value gaps. Do we have anything? No. If we go to the 15 minute, we have nothing, right? Because price happened so quickly that there's not much to do. Now, as an example, here's the thing that I do different from ICT. And ICT says that around this level, not around this levels, after a run and buy side liquidity, we will be looking for displacement on the 5, on the 4, on the 3 minute, the 2 minute, and the 1 minute, right? Again, also with the market shift. So as an example, what is that we have here? The 1 minute goes aggressively lower, creates a fair value gap, and along with that, there's a market shift. Tiny bit of a market shift because if it's just done with the 1 minute, with the tiny bit of a week, but we definitely have, well, we have this one up here, but theoretically we will always have our entry on the most recent one. That is again inside of this tiny bit of a range to trade from that, right? That would have been our entry there, stop loss up there, target below this liquidity. We'll talk about the target in a minute. So based on the way that I trade, where I wait for the 5 minute to be created first and then look for the 4, the 3, the 2 minute, right? As an example, if we go to the 4, what is it that we have? We have a little bit of a messy price action first, but then we see the displacement that happens pretty close to the market shift, and the market shift is also cost. So as an example, this could have been the entry, or this is where we could have looked for a 1 minute entry when price mitigated that fair value gap. Based on ICT's teachings, this would have been an entry by just going for the fair value gap created on the 4 minute. On the 3 minute, we also do get this one. On the 2 minute, we get another one as well, right? So pretty cool, right? Pretty cool. So for me, there were no sells on this, but then, of course, the continuation of the trend is what allows me to take this tiny bit of a sell on that, which creates a fair value gap, right? Just following the trend at this point because we do have some good confluences to sell, and we have the run above this high, right, which is the 5 minute fair value gap's low, goes aggressively lower, and this is the entry, right? Also a little bit of liquidity happening here, another fair value gap on that. Simply that, right? Simply that. That would have been the entry, and target was, we're going for the liquidity, which would have been a problem today because, as an example, if I'm seeing what I'm seeing all the way down to the left, I'm definitely expecting price to take this low. If I want to be conservative, then I might say let's just go for price to react to this, because as an example, even though we know that these lows are going to be taken sooner or later, we never know if it's going to be taken today, if it's going to be taken in the next hour, 2 hours, but basically being this close, something like this could have easily happened. Reacts again, tiny bit of a retracement, maybe still respects this entire areas of reaction, and then we see another entry that ends up taking the lows, right? Or maybe price decides to go even further away from that, right? It could have gone just further, take more buy side liquidity, then take that, and then continue higher. You never know when the liquidity is going to be taken, so we do have to remember that. based on price going in that direction, we could expect it to we could have expected it to take it now, as we're pretty close to it, and we have multiple confluences to be selling, clear around a buy side and everything. But yeah, that would have been a difficult target. I don't really remember what I did with this, but I do believe I took some profits, or at least partials, down on this low when I took paper trading trades. This is not a trade I would have taken on a funded or funded or challenge, because this, well, not this, between this low and this high, that's where I want to see the fair value gaps being created, as you'll see in the next few trades. But as an example, on this one, we have the market shift here, the high here, the impulse, and there's a fair value gap in here. If the fair value gap would have happened here, for me it was of no use. And if we had another one in here, I would expect that one to actually work out and not this one, right? To then continue lower. And if no fair value gap was in here, but then another one in down there, again, exactly the same thing. I'm not trading that one. Okay, so it's basically Tuesday. Just price creating more and more liquidity. We also have price mitigating a 50-minute fair value gap. Nothing much more than that. Based on power of 3 or market protraction, we do have some signs like this, and then the immediate reaction. This tiny bit of a high, this tiny bit of a high, and also the run and buy side liquidity. A lot of things that we could have expected, that we could have used to expect the market to be bearish for the day, or as well bullish. But the problem with the bullish side, again, was the sell side, right? It was the sell side liquidity that was just there, right? Basically just there. Is that fine? Yeah. Let's go to 5 now. Got a couple of interesting things on. This is Wednesday. So, Wednesday. Midnight opens. Based on the power of 3, we see that price trades immediately higher. There's multiple buy side liquidity being taken. All of these highs, couple of these highs, right? All of that was taken, even this tiny bit of a high that is created right there. And then you can see immediate change in direction and price just going lower. We have a little bit of a move against the trend here. I mean, the open is on this level, so it doesn't trade above that. It doesn't trade above London's open, but that's fine. But basically, as you can see, it does go above midnight's open as soon as it opens. So basically, that's a little bit of a manipulation, and then price just continues lower, right? So for me, that is pretty much it. That is pretty much all that I can actually do to try and look for sells based on the power of 3 and the midnight price action, right? Then London goes aggressively lower, and we do continue to get confluences to sell. We have a little bit of equal highs on this, or just that high on the 5-minute. The price trades above and then continues lower, right? Now the thing is, sure, we have multiple indications to look for lower prices through the London session. Now, when we have indications based on liquidity, based on power of 3, based on just order flow, right, how price is trading, we always have in mind the fact that that's not going to last forever. And we have in mind the fact that, not have in mind, but basically we have to understand where is price likely to stop. Right, so indications where to sell, question is to what? If we're selling, we'll look for the next run and sell side liquidity. And we had this pretty close to us, right? Pretty close to us. So this is definitely something that we could have used to understand that if price is going lower, it could be reaching into these lows to then do whatever it wants to do. So for me, London quite aggressively, right? Quite aggressively reaches into those lows, takes those lows, goes a little bit of a retracement. We could say that this is a little bit of a manipulation, right? So then continue a bit lower through pre-New York. And then we see a little bit of aggression as soon as the market opens. Could we say that we had manipulation on the open of New York Kill Zone? Not really, because it does go higher, and that's what the trend ends up being. But what reasons do we have to be buying? The major run and sell side liquidity, tiny bit of a range that is taken as liquidity, tiny bit of a range, aggression higher, market shifts, multiple stuff that is created after the run on this liquidity and on this, right? So what happens later that allows us even further into this trade? Have a 5-minute order block here, price trades into that. We have a 5-minute fair value gap, price trades into that. We have 8:30 open is this candle. As you can see, trades immediately lower. That's the market protraction. That's the move against the trend, that's the manipulation on the power of 3 concept, and then the aggression higher that causes a market shift. Well, yeah, it causes a market shift, sure. We have fair value gap here. It's pretty high up. Always keep in mind that we want to be buying low, selling high. So what would that mean in this case? This is point of equilibrium, right? This is what separates premium to discount, right? So we see price trading above premium. Sorry, not above premium, in premium. So this is definitely something that we don't want to be buying. We don't want to buy when price is high. We want to be buying when prices are low and selling when prices are high, right? So this is not an area where I want to be buying from. And then price reaches into discount, which is below the 50%. If further than the 50%, then even better. And what is it that we have to the left? A little bit of a fair value gap in the 5 minute. The price reaches into, and what is it that we have later? Aggression. We could say that this is a market shift with the displacement, right? The displacement on this, and basically just the aggression. Market shift again. And then another fair value gap, which is where we could have looked for lower time frame opportunities, as an example, right? So you have that order flow, which we already discussed through the week, right? But basically have multiple reasons to believe price could easily go higher in this case, right? We have, first of all, we have the run and sell side liquidity through the London session. Then there's more sell side liquidity being created through pre-New York. Then as soon as New York Hill Zone opens, trades higher, market shift, order blocks are created, run and sell side is created, run and sell side happens right before, causing 5 minute fair value gaps, 15 minute fair value gaps and everything. Price then goes higher, and we have power of 3 on the 8:30 session open, right? Or market retraction, however you want to call it. There's a 15-minute order block in this. Price trades back into that 15-minute order block, trades back inside that 5 minute fair value gap, trades inside a discount based on this most recent move, and maybe with this. Yeah, even on this, it trades back into equilibrium, right into this entire price action. Right, so we have multiple reasons to believe why this area is a pretty great area to buy, right? And if we get to lower time frames, this was my issue today, because if we look at it the way that I trade, what do we have here? We have run on sell side, 5 minute fair value gap, 5 minute fair value gap in here. Price trades aggressively higher, more a displacement in the 5 minute, lower time frame entry. The lower time frame entry is created in this case, it's just that it wasn't mitigated right away as I'm used to. And as you'll see, this is the 1 minute fair value gap. Why would we gone for that? We have displacement as soon as we mitigate a 5 minute fair value gap and run a sell side, right? So let me let this one. Price trades inside 5 minute fair value gap. There's a sweep on liquidity. We could call this the market shift. I would have very likely used this one. Either way, it's exactly the same because both are broken right away. And you can see how the displacement is clearly there, right? This is what I would have gone for. Ideally, not ideally, but basically if another fair value gap is created higher, we would trade this, right? This fair value gap in here. But I didn't want to do that. I wanted to be triggered on this. Goes higher, higher, higher. And at that point, I'm really not interested in buying again, or not in buying again, but basically expecting price to come back down to this and then respect that. And as you can see, that's exactly what ends up happening, right? Price trades back into this area and then starts going aggressively higher. This is as well, we saw a 5 minute fair value gap being created with something like this. The lower time frames do not create an entry up until this point, right? And price does not trade back into it. Right. So did we have reasons to buy? Definitely. Did we have reasons to sell? In my opinion, no. We didn't really have reasons to sell because we have a lot of sell side liquidity being just taken. So we're definitely going to look for a good amount of buy side liquidity, right? A good amount of buy side liquidity. So my opinion, really cool day to be buying. Lower time frame entries were a little bit complicated today, but could have been achieved. We have multiple reasons. The sell side, fair value gaps, order blocks, market retraction, or just simply manipulation, right? Runs on sell side liquidity. Had a lot of things to believe that price was going to be bullish for this day, and it definitely was. So, okay, let me do a little bit of this. Let me clean up what we have to the left because we've already discussed it. We're gonna go to Thursday, which is going to be the last day of the week from what we'll be we'll be analyzing. And we're gonna begin with what happened first, which basically happened through midnight. And let me actually delete this Fibonacci because it looks a little bit messy. I want to explain it from scratch. So, clear run and sell side liquidity. Look at what it causes. This is exactly what we look for when high or low is taken. Immediate displacement. We can see it on the 50-minute. We can see it on the 1 hour. We can see it in multiple time frames. Right on the 1 hour, it looks a bit cleaner. Probably 2 hours looks fine. Yeah. Pretty aggressive move. What happens up here in the meantime? A lot of buy sides taken. Not a lot, in my opinion, but we do have this pretty aggressive high. And this other high that it happens around the same level. All of this, so you can see multiple reactions. All of that has liquidity, but of course there's liquidity in the middle that is taken by this high. So that's why I don't really like considering what's in the middle, right? So price trades above that, and then you can see this. If we want to look at it from 1 hour, from 2 hour, the 1 hour, whatever it is, we can see that price takes the high, a little bit of an impulse, a little bit of a range, aggressive move down, and that generates a market shift. With this structure, without the need to go down to this point, right? Without the need of that. And that's because you can see that there's displacement when causing the break of a low in this case, right? The market shift in this scenario happens because a low is broken, which is a market shift. But if the market shift happens without displacement, without the creation of fair value gaps, and that's of no use, right? So basically, after that happens, we could say, okay, so we have a 1 hour fair value gap, we have a 2 hour fair value gap. So there's a lot of things that we have, but there's something, and what I'm going to show here and explain here is something that I learned from, again, ICT's core content from on his YouTube channel, the stuff that he's been uploading lately. And I don't remember exactly what episode, but I do believe it's around equilibrium and premium, equilibrium versus premium or versus discount, or around the first few chapters. But the thing is that he explains that consolidations don't cause a reversal. Don't cause a reversal, don't cause a retracement, it causes continuation, right? Or expansion, he said, actually. So, and on what we will look for to trade is around the 50% of that range or that consolidation, you can find the order block that price leaves for it to later trade into. It's a little bit confusing. It's not something that I'm going to explain further than that because I don't really know the exact concept. I'm just paraphrasing in a very worse way than what he actually teaches, so you can just go yourself and check it out, right? But basically, putting it into a few words, when you see a consolidation and then there's an expansion, you can apply the Fibonacci to that. It was actually fine. You're gonna apply the Fibonacci to that, and we're gonna do it. Let me actually do this. And levels, right, middle, and for 10, sure, why not? Hold F2. The levels, I can't really explain why they're important. Thing is that is 0.5, 0.62, 0.705 or 0.75. I'm not entirely sure about that one. I do believe it's 705. That's pretty much it, basically this one, and then 0.768 of that one, I'm sure. But basically in here I'm showing it like this because we have 0.5, 0.62, price taps that to the tick and starts going lower. Now if we go to the 1 hour, if I remember correctly, we have this, could be considered an order block, but no, this is not the chart. 15-minute, no, the 5-minute. I've forgotten about that one. If we look into this, you see this is an order block, right? This is the last order block that you can see down to this one, of course. This will be the next one if I understand order blocks correctly, although he hasn't taught, at least as far as I am into the core content, he has not explained order blocks just yet. So we have a range, we have a Fibonacci. Around the 50% we should be able, 50% or higher. Higher is better as far as I understand, right? But basically have a Fibonacci, an order block right there. Price mitigates that right there. By how much? 0.5 pips, 0.5 ticks. Not 0.5, 0.5 pips. Basically half a pip mitigates it, and then you can see price going lower. And if I remember correctly, we also had the fact that this entire thing, this is the way, yeah. Price was mitigated in the 50, sorry, as well as the lower fair value gap, or the smaller fair value gap in here, right? So I'm showing this because why am I showing this? Because I found it really interesting, right? And I actually did this morning, not this morning, but the morning of this price action, see how price came back up here on London and then started reacting to that. And I saw, well, this is an impulse, right? Overall, this is an impulse. This could be a retracement up to something, right? And then the continuation. Then I saw the range, and I thought, well, the range, we can apply the Fibonacci to that and look for whatever we have around the 50%, which could be an order block. And also, the first thing that I actually saw was this, but I think I got it wrong, because this is the order block that I saw first, from this low being all of these candles, but there's a black candle in here, so that's a bearish candle, which supposedly wouldn't be considered an order block because it's not consecutive candles, right? This will be the only candle or order block that we could actually use. As you can see, price has not mitigated. If it wasn't this one, well, it will be actually quite exactly to the tick, right? That's why I drew it at first, but then realized that we had that bearish candle in the middle, which kind of ruins it, because this is supposedly not an order block, right? I'm not going to explain what an order block is based on ICT, because I don't really understand it, because he hasn't actually taught it as far as I've seen the content, right? But hopefully he does explain it finally, although he has said that there's things about order blocks that he's just not going to talk about. So why is that important, right? It's not important for us to execute a trade, but it is important for us to understand that price does have a pretty good reason to go lower, and is what we just talked about, right? We also have the fact that a lot of buy-side liquidity has been taken, and I almost forgot about this one. If we go to the bigger parabolic gaps, Fibonacci's, this is pretty much as far as we can go, right? So we're in a pretty good spot. We have a Fibonacci on this move lower. There's buy side being taken, and then we have this major impulse that allows us to place another Fibonacci, that allows us to look for a lower time from entry. And yeah, we just have had that other Fibonacci that I wanted to mention as well. So we had multiple reasons to believe price could go lower, and taking away the Fibonacci things, let's talk about why could it go lower, right? Because if we want to stick to what I used to do, what I teach so far, what I've taught so far, is the fact that, well, price midnight trades a bit lower, right? Then starts going aggressively higher. London opens and trades lower. So what is it that we have here? Manipulation, power of 3, right? Market protraction. We have a move against the trend, goes higher. What does London do? The exact same thing. Move against the trend, market protraction, manipulation, simply, right? What happens in that manipulation? Price goes aggressively higher and then continues going, that's fine, going higher, right? So could we, if we were trading in London as an example, and we started trading around here for some reason, could we expect price to continue to go higher? Definitely. We have the reasons to believe that. We have midnight, we have the fact that, as an example, there's sell side being taken from here. So definitely we could go higher, maybe up to these highs, maybe up to this ones, right? So could we expect that a bullish market from London? Definitely. We had the reasons to believe that. Now, why would we expect that a bearish market on New York, which opens here? We have the fact that price through London went bullish, taking some buy side liquidity, and mitigating fair value gaps in here. Right, we have a 1 hour fair value gap, we probably have 15-minute, we probably have, I do believe we had a 4 hour, we can check that later. But basically, a lot of buy-side liquidity taken. As you can see, price does change the direction, creating fair value gaps and respecting them. We even have a 15-minute fair value gap here that through, well, the open on New York Kilson begins inside a 15-minute fair value gap and after taking a highest liquidity, right? So definitely a good point to be selling. Also, we've just broken this low, right? Confirming or basically just following this, right? Lower low, lower high, lower low, lower high, lower low, potential lower high to continue lower, right? Could we say that this was a run on sell side to now potentially go higher? Definitely. Do we get the confluences to that though? We do, kind of, right? Because price does go aggressively higher, takes a high, potential market shift, fair value gaps to trade from, and this could defend the lower time frame entries. And actually, on the live recording of this day, I did take an entry on paper trading, or was it? No, I actually didn't take an entry because I analyzed it after it happened. But basically, there was a buy that we could have taken advantage of and could have been fine. But as you can see, we did have multiple reasons to believe price could actually go lower, right? But basically, if we start trading from a 30 open, which is this, what is it that we have here specifically? If we look to the left, well, we've already analyzed London. Pre-New York, basically just continue with that trend, creating fair value gaps, mitigating them, and here we have a little bit of a move against the trend. Again, we kind of look for that manipulation to happen after the open, which we do get some bullish candles, but not really above the open, which is what we would have ideally seen, right? But market was quite bearish, and that's why I took the entry that I took, but we'll get into that in a second. As you can see, price just basically continues to respect that bearish trend, right? How do I trade? I look for run and stops, displacement on the 5-minute, and lower time frame entry on 5-minute or 15-minute fair value gaps, right? So that's exactly what happened today. That's exactly how I was able to take an entry that, again, as I mentioned on the video, it's definitely an entry that I would have taken on a fund or a challenge account scenario, right? But the problem for me was the fact that this is what we were targeting, which is previous day's low, right? And we don't really have a good risk to reward ratio, right? So two things that we have here: price, this 830 open. We do have price trading a little bit higher. This could be consumer manipulation. Of course, it's so tiny. It's a movement so tiny, so small, so insignificant that that's not something that I consider manipulation nor market retraction in any way. So for me, that was not enough to say sure price could go lower just because of this manipulation, right? If it would have taken this tiny bit of a high, then great, right? It's a little bit better, but still complicated, right? It's just not something that I would have considered enough as manipulation, nor what we had here. Aggression, I do believe we had news at 8:30, not high impact or anything, but the thing is that 15-minute fair value gap is created at this point. We have this high, price goes above the high, mitigating 15-minute fair value gap, and we then get this displacement, right? So we have run and stops, right? We have the run and stops, 5-minute displacement, which was around here, was the first fair value gap, and then price creates a second one, price. So what is it that we have? We have run and stops, displacement and market shift, and third, lower time frame entry inside a 5-minute or 15-minute fair value gap, right? That's exactly what happened. Price trades inside a 5-minute fair value gap, drops aggressively lower, creates that fair value gap, that's our entry. If it would have gone higher up to this one, then great, we just look for the exact same thing, right? Market shift, potentially around sell on buy side liquidity, and then our entry around a fair value gap in here, right? Inside this high and low. That would have been the entry, and well, we would have taken a loss, and of course we would cover with that next sell. Target wise, we would have been looking for previous day's low. We would have not expected, I mean, even if, well, yeah, I said that this is a trade that I would have taken and funded, but the thing is that around here, around one of these candles, 5 minutes approximately before the news, I would have closed. So that means at this candle specifically, I would have closed, right? So I would have missed out on this huge drop, but that's just better, right? Just better to miss out on this move, because if the exact same would have happened but going higher, it could have skipped my stop in here, take me out for twice or 3 times basically what I was risking, and that is really not fun, right? That's not fun. I've never thankfully, right, I've never had price skipping my stop loss through news. It tends to maybe trigger the stop loss a bit later, making me lose a little bit more, but instead of, as an example, instead of here, it triggers it here. But if you have something a little bit faster, it could just do this. And I mean, sure, within the 0.5 seconds that it takes to trigger the entry out, you're here, right? Instead of being a little bit higher, it's here, right? And it's just better to avoid that, right? That's why I don't trade through nor before nor after high impact news for at least 5 minutes before, 5 minutes after. And usually they tend to ruin the price action anyways, so yeah, it's just better to completely skip them. So that will be pretty much it. It was a good week. I do believe I ended the week profitably, and if I would have traded on funded, the ones that I said I would have, I think I would have taken the loss on, what day was it? On Thursday, which was quite bullish, and I would have taken a sell. I do believe I had the reasons to do that, but after this run of sell side liquidity, you can't really be selling. You need to be, it's not that you need to be buying either, but confluence is were in that favor. And so I would have taken that loss. And then we basically have this one, isn't it? Because yesterday, this is the loss. And then what? Oh, the selling here. No, this is not something I would have taken on a funded, as far as I remember. Yeah. Because sure, the market shift, I mean, if we consider the market shift being when price actually causes a fair value gap or displacement, this would have been the actual market shift and this displacement. So presumably, this entire area is where we look for fair value gaps. So this could have been taken if we look at it from that way. The price is pretty low at that point, and I would have not gotten a nice price risk to reward ratio, and I would have ended up in a break even very likely due to the price actually respecting the low that I would have not expected it to. So it would have been complicated. This would have been a nice missed out opportunity, just not the way that it works. But this is something that I would have taken on a challenge funded for sure. We do have multiple reasons to believe why price could go higher. And then this one, but again, both the news and the risk to reward ratio would have been a little bit of an issue. So nothing for me to do about that one, honestly. Would have been actually just one loss for challenge for funded accounts this week. Basing ourselves on what we just discussed, right? There weren't multiple opportunities as I would have liked, right? And it is what it is. I'm not going to talk about Friday because Friday was boring and we had news, right? As you can see, run on sell side, run on buy side, continuation higher, takes a high, drops lower. That's pretty much what happened. Price was just going higher, and that's basically what it did. But also, we do have this. 4-hour order block. I always forget how to place the Fibonacci. And 6, 7, 8 level, as you can see right there. And in the lower time frames, we do have the 1-hour order block is also down there, but I do believe that the 15-minute yeah, it's a tiny bit of an order block there. That would have been missed out on. But this, that order block right there, 15-minute, mitigates it to the pip. Not something I would have traded, but as you can see, keep in mind everything, right? Keep in mind that this is a clear retracement, because look at how price is going. This is an impulse, this is a retracement, this is an impulse, this is a little bit of a retracement, but then you can see how it turns aggressively lower. This is an impulse, this is a retracement. Look at how prices go slowly up to that, right? So keep in mind that that's displacement, that's retracement. Have a 15-minute order block, Fibonacci, 4-hour order block. Price has just taken a high, and also, was that respected there? Yeah, almost. I mean, it does kind of create equal highs, goes above that. Market shift, clear market shift with fair value gap, right? Displacement and potential entry. this is a day that I completely avoided. Had some issues with the computer as well, so I kind of wanted to fix that, and I took the day for that. And yeah, there's the open, run on sell side, run on buy side, continuation of the trend. As I mentioned a couple of times already, as you can see on this one, price does come back down to where it began, right? News tend to just mess price up for nothing, right? Because it just returns what it wanted to be anyways, or what it was before the news. But as you can see, this is a somewhat clean sell opportunity. I don't think we actually got anything on the lower time frames. We didn't, as you can see. Mitigates the 5-minute fair value gap. There's no fair value gap in the 1 minute. This is something maybe, but market shift happens here. Well, actually, market shift happens here. Fair value gap's all the way up there. 4 minute might have been something. Doesn't trade above that fair value gap in the 4. Market shift in the 3 minute happens on this low. Fair value gap kind of created outside. Would have gone for this. So even if I would have understood this, it would have been just complicated, right? We do have reasons to believe price could go lower from that point due to all of what we just discussed: the buy side liquidity, the fair value gaps, the order blocks, and everything. But overall, just a pretty complicated scenario that yeah, I mean, it does work out. Due to price going aggressively lower, we could have expected the price to retrace up to this. And ICT, actually, one of the classes that I watched yesterday from... because he explained fair value gaps in another way, but if I understood it correctly, from this bullish candle, or actually this one, no, from the low broken that causes the market shift down to the next bullish candle, that will be a fair value gap. So this is a liquidity void. And all of this is an easy zone to trade. This area is low resistance or something like that. Now, when it gets down to this low, that's when price starts to cause rejections or potentially just completely turn around, which was quite true in this case, right? Even though it does continue to go higher, it does take each impulse, it goes even a little bit less further than the previous, right? This one was a pretty large impulse. This one wasn't that much, and this one barely got above the highs, took the liquidity and just dropped lower. Yeah, if we wanted to buy, this was definitely, up to this point, this was definitely a pretty good area to do that. And also we have the fact that we're on premium prices, right? And look at how the 705 is actually really well. We're at discount prices, sorry, going up to premium prices. We also had this one, which price rejected close to the 705, as you can see. And we had the major one, which was this one, and even better, 705 right on this last bullish candle right there. Beautiful, right? Beautiful. Again, it's once one follower asked me if it's good, not good, but if it will be okay or good or necessary for a person trying to learn the ICT mentorship to watch the core content, and I would say no. I would say no. I will just focus on the ICT mentorship, which, being honest, I've been watching it again, as I've mentioned. I'm around episode 25, 26, don't remember. And there's a point where ICT starts teaching structure. Those episodes I completely skipped them because I don't really like the intermediate term low, long-term low, or high, of course. That's something that I'm really not interested in. It could be insightful for sure, because this could have determined that this high was not to be broken, nor this one, which could have allowed us to sell from that. But I'm really not interested in that type of market structure. It's like advanced market structure, and I'm just really not interested. It's lots of effort, in my opinion, for something that is not necessary. Of course, nothing is really necessary, but there are things that you need to know to be able to do certain stuff. But for me, market structure in this case is just not necessary. That's why I completely skipped it, right? And yeah, there are further into, if I remember, episode 30th or something like that. That's when I previously stopped watching because I just wanted to. I just wasn't interested in what he was teaching. Then he started doing like the mark reviews and everything, like examples and stuff. Those are really good, right? But not really note taken worthy. Sure, you take notes about the like how he took the trade and everything, how everything worked, but nothing much more than that, honestly. So yeah, but first of all, watch ICT mentorship, understand it, be able to trade with it, right? Be able to find opportunities to demo opportunities and everything. And when you understand that, maybe that's a somewhat good time to um go back in not go back, but basically go into core concepts, core content from ICT, which is pretty good. It's really good, right? It's really good. We have the Fibonacci's, the order blocks. He explained this liquidity void stuff that could have allowed us to buy it all the way up to this low. Multiple stuff, right? Multiple stuff that would have been definitely interesting to know previously. That's pretty much it. So hope you enjoyed this video. A little bit of a long one. Thank you for watching. Thank you for being here. And that's pretty much it. Hope you enjoyed. Hope you took something away from it. And I'll be seeing you on to the next one.